Have you ever looked at a stock chart and felt like you were trying to read some ancient lost language? It just looks chaotic, right? Random, maybe even impossible to predict. But what if I told you that underneath all that noise, there's a single incredibly simple force that moves every single market in the world? Well, today, we're going to pull back the curtain and show you exactly what that is.
I mean, you look at any chart, stocks, crypto, it doesn't matter. The price zigs and zags all over the place. And it just begs the question, what is really making those prices go up, down, and sideways? Is it some, secret formula, a super complex algorithm? Well, the answer, it turns out, is something we all deal with every single day.
And that answer is the law of supply and demand. It's this super fundamental economic idea, and it basically just says, look, when a ton of people want something and there's not much of it to go around, well, the price is going to go up, right? And the flip side is true too. When there's a mountain of something available and nobody really wants it, that price has to come down. It's that simple, and it's something you already know deep down.
And you know what? This isn't just some dusty old theory for economists. This is a universal law that governs the price of pretty much everything around us.
I mean, think about it for a second. Why do tickets for that superstar's concert sell for hundreds, maybe even thousands of dollars? It's all about high demand and a really limited supply. Or why does a house in that one cool neighborhood cost a fortune? Same deal. This principle is literally woven into the fabric of our everyday lives, right down to your morning coffee.
Okay, so if this law works for concert tickets and coffee, does it really hold up in the world of financial markets? Oh, you bet it does. Absolutely. They are driven by the exact same forces. No exceptions whatsoever.
And when I say every market, I mean it. We're talking about stocks, the foreign exchange market, Forex, commodities like oil and gold, and yeah, even the wild west of crypto. They all dance to the very same tune, supply and demand.
The best way to really picture this is to think of it like a constant epic tug of war, okay? On one side of the rope, you've got the buyers. They represent demand, and they're pulling that price up. On the other side, the sellers. They're the supply, and they're trying to pull the price down. The price you see on that chart at any given moment, that's just where the little flag on the rope is in that game.
So what gives one side of that tug of war a sudden burst of strength? Well, it's stuff that happens in the real world. A big news story breaks, there's a major economic announcement, or sometimes it's just the general vibe of the market, what we call sentiment. All these things influence whether more people suddenly want to buy or sell, and that shifts the balance of power.
Okay, so keeping that tug of war in mind, the price can really only do one of three things. Let's break down each one.
All right, scenario number one. What happens when demand is bigger than supply? This means the buyers are just pulling way harder than the sellers. In that case, the price has literally nowhere to go but up. There's just more competition for the asset, so buyers are willing to pay more to get their hands on it.
Now let's flip that. What happens when supply is greater than demand? Well, now the sellers are the stronger team in our little tug of war. You've got a ton of sellers all scrambling to attract a smaller pool of buyers. And to get a sale, what do they have to do? They've got to lower their price. That's what drives the whole market down.
And what about the third option? Well, that's when supply and demand are pretty much equal. The buyers and sellers are kind of in a deadlock, right? Neither side has a clear advantage. When this happens, the price just tends to move sideways, bouncing around in a range until, one side finally gets a burst of energy and takes control.
So this is all great theory, but here's the crucial part. How do traders actually use this? Because it's not just an interesting idea. It's the absolute foundation of a core trading strategy.
And really, it boils down to a pretty simple two-step approach. First, traders try to spot these zones on a chart where supply or demand seems to be really concentrated, places where a big imbalance happened before. And then, step two, they try to anticipate what's going to happen next. The classic goal, of course, is to buy low in one of those strong demand zones and sell high in an area with a ton of supply.
Okay, let's bring this all home. Remember that chaotic, random-looking chart we talked about at the very beginning? Well, once you understand this tug of war between supply and demand, you can start to see it in a totally different light.
So, here's what you really need to remember. Every single little wiggle you see on a price chart, that's just reflecting the constant battle between buyers and sellers. And the things that give one side an edge are real-world events, news, economic data, all that stuff. But here's the big one. Once you get this, what looked like pure randomness starts to look like actual market structure.
And that is the ultimate goal. The whole point of understanding this principle is to be able to make decisions that are rooted in that market structure, not just based on randomness or, dumb luck.
But this leaves us with one last, really important question. If the core idea of supply and demand is really this simple, what makes actually applying it, trading and investing, so incredibly difficult for so many people? Now, that is a topic for another day, but it opens the door to the whole other world of trading psychology and execution. Thanks for joining me.